Hello! Welcome to Capital Sensei. Today, we're going to dive deep into one of the most important biographies in the world of finance. Warren Buffett, The Making of an American Capitalist by Roger Lowenstein. We'll explore the man behind the legend. From his earliest days as a young boy obsessed with numbers in Omaha to his transformation into the world's most successful investor. We'll unpack his core philosophies, the influence of his mentors, and the key deals that cemented his legacy, showing you how his principles can be applied even today. Whenever we can, we try to answer questions left in the comments. Learning about finance is a journey, and no one should have to do it alone. So please, feel free to comment with your questions, share your own experiences with investing, or tell us what you think about Buffett's methods. Your stories and insights help everyone in our community learn and grow. Let's start at the very beginning, in Omaha, Nebraska. Warren Buffett wasn't born into unimaginable wealth, but he was born into an environment that cultivated his natural talents. His father, Howard Buffett, was a stockbroker and later a four-term congressman. From his dad, Warren learned two fundamental things: an unwavering moral compass and a deep-seated distrust of Wall Street's conventional wisdom. While other kids were playing with toys, young Warren was chalking stock prices on the sidewalk and devouring financial books from his father's office. His entrepreneurial spirit ignited early. We're not just talking about a paper route. Yes, he delivered the Washington Post, but he did it with a level of optimization that was unheard of. He figured out the most efficient routes and even started selling other items along the way. He bought 6 packs of Coca-Cola for 25 cents and sold the individual bottles for a nickel each, a 40% profit. It was a simple business, but he was fascinated by the numbers behind it. The pure mechanics of turning a small amount of capital into more capital. One of his most famous early ventures was his pinball machine business. As a teenager, he bought a used pinball machine for $25 and convinced a local barber to put it in his shop. They'd split the profits. Soon, the machine was generating so much cash that he bought more, placing them in other barbershops. Within months, he had a small empire of pinball machines. Think about that for a second. He didn't just see a game, he saw a recurring revenue stream, an asset that worked for him even when he wasn't there. He was learning about cash flow and return on investment before he could even legally drive. After being rejected by Harvard Business School, a twist of fate he now considers one of the best things that ever happened to him. Buffett discovered that Benjamin Graham, an investor he idolized, was teaching at Columbia University. He immediately enrolled. This was the moment that his raw, intuitive talent for business met a rigorous intellectual framework. Going to Columbia to study under Graham was like a talented street musician getting a scholarship to Juilliard. It gave him the theory and the discipline to turn his talent into genius. Ben Graham is widely known as the father of value investing, and his philosophy was hammered into Buffett. Two of Graham's ideas are absolutely central to understanding Buffett's entire career. The first is the concept of Mr. Market. Graham told his students to imagine they were partners in a private business with a man named Mr. Market. Every single day, Mr. Market. Market comes to you and offers to either sell you his share of the business or buy your share at a specific price. Sometimes, Mr. Market is euphoric and wildly optimistic, and he quotes a ridiculously high price. Other days, he's panicked and depressed, and he offers to sell you his share for far, far less than it's worth. Graham's lesson was simple. You are free to ignore him. You don't have to trade with him just because he's shouting a price at you. A true investor uses Mr. Market. Market's mood swings. When he's pessimistic and offering you a bargain, you buy. When he's ecstatic and offering you a silly price, you might consider selling. This allegory perfectly describes the stock market, with its daily, often irrational price fluctuations. The second core idea from Graham was the margin of safety. This might be the single most important investment concept ever devised. It's actually pretty simple. The margin of safety is the difference between the fundamental value of a business, what it's really worth, and the price you pay for it in the market. Graham insisted on always buying with a significant margin of safety. It's like building a bridge that needs to support a 10-ton truck, but you design it to hold 30 tons. That extra capacity is your margin of safety. It protects you from miscalculations, bad luck, or unforeseen problems. For an investor, it means buying a stock for 50 cents when you've calculated its intrinsic value to be at least $1. That 50-cent cushion is what protects your capital. It's the bedrock of preventing permanent loss. Early in his career, Buffett followed a specific type of Graham investing that he later nicknamed cigar butt investing. The idea is that you walk down the street and find a discarded cigar butt on the ground. It might be soggy and disgusting, but it has one good puff left in it. You pick it up, take that final puff for free, and then throw it away. In investing terms, this meant finding companies that were trading for ridiculously cheap prices, often for less than the value of their working capital. These were usually terrible businesses, but they were so cheap that you could likely buy them, liquidate some assets, and get that one last puff of profit. It wasn't about finding great companies. It was about finding lousy companies at a price so low you couldn't lose. This was pure, unadulterated Ben Graham. After graduating and working for Graham's firm for a couple of years, Buffett returned to Omaha in 1956 to start his own investment vehicle, the Buffett Partnership. He was 25 years old. He pooled money from a small group of family and friends, about $105,000 in total. He set up the partnership with a fee structure that was unheard of at the time and is still rare today. He called it a 0, 6 1/4 model. Here's how it worked. Buffett took zero management fee. He only got paid if he delivered returns above 6% per year for his partners. So, if the partnership returned 5%, he got nothing. If it returned 10%, his partners got the first 6%. And then Buffett took a quarter, or 25%, of the remaining 4%. This structure was revolutionary because it perfectly aligned his interests with his investors. He only made money if they made significant money first. It was the ultimate skin-in-the-game approach. And the results? They were staggering. Over the 13 years the partnership existed, from 1957 to 1969, it achieved an average annual compounded return of 29.5%. During that same period, the Dow Jones Industrial Average returned just 7.4%. He didn't just beat the market, he completely annihilated it, turning that initial $105,000 into over $100 million by the time he dissolved the partnership. One of the most telling investments during the partnership years was his stake in American Express. In 1963, the company was rocked by the salad oil scandal. A subsidiary of American Express had issued loans against vats of salad oil that it turned out were mostly filled with water. The market panicked. Wall Street assumed American Express would be on the hook for massive losses, and that its reputation was ruined. The stock price was cut in half almost overnight, but Buffett didn't panic. He did his own research. This wasn't about complex financial models. It was about common sense. He went to restaurants, banks, and travel agencies. He observed people using American Express traveler's checks and credit cards. He asked cashiers if they were still accepting them. He concluded that the scandal, while serious, hadn't damaged the core, powerful franchise of the American Express brand in the minds of consumers. The underlying business was still incredibly profitable. So while everyone else was selling in fear, Buffett invested 40% of the partnership's capital into American Express. Within a few years, the stock had risen fivefold, and he had made a fortune for his partners. This was a masterclass in his famous maxim: be fearful when others are greedy, and greedy when others are fearful. In the mid-1960s, Buffett made an investment that would change his life forever. He started buying shares in a struggling New England textile mill called Berkshire Hathaway. At the time, it was a classic cigar butt investment. The company was in a terrible, dying industry, but its stock was trading for less than its working capital. He was just looking for that one last puff of profit. He planned to sell his shares back to the company's management at a slightly higher price. However, when the time came, the company's manager, a man named Seabury Stanton, tried to chisel him on the price by 1/8 of a point per share. This infuriated Buffett. In a fit of anger, instead of selling, he did the opposite. He bought enough shares to take control of the entire company. He fired Stanton and suddenly found himself in charge of a doomed textile business. It was, by his own admission, a huge emotional mistake. But this mistake turned out to be the foundation of his empire. For years, he struggled with the awful economics of the textile industry. No matter how efficiently they ran the mill, foreign competition with lower labor costs was always eating away at their profits. It was a business that required constant reinvestment in new machinery just to stay afloat, with almost no return. It taught him a crucial lesson. It's better to be in a great business with mediocre management than a terrible business with brilliant management, because eventually the economics of the business will win. This experience led to a profound shift in his strategy. He realized that trying to fix the textile mill was a fool's errand. Instead, he began to use the small cash flow the mill generated not to reinvest in more looms, but to buy other, better businesses entirely. Berkshire Hathaway, the failing textile company, became the holding company, the vehicle through which he would acquire a collection of wonderful businesses. This was the transition from cigar butts to collecting masterpieces. This evolution in his thinking was massively accelerated by his friendship and partnership with Charlie Munger. Munger, a lawyer and investor from Pasadena, was just as brilliant as Buffett, but with a different kind of mind. If Buffett's strength was an intense, laser-like focus on business and finance, Munger's was a broad, multidisciplinary wisdom, drawing from psychology, history, and science. They were the perfect intellectual complements. Munger is the one who famously told Buffett, "Forget everything you learned from Ben Graham about buying fair companies at wonderful prices. Instead, buy wonderful companies at fair prices." This sounds like a subtle difference, but it's a monumental shift. A fair company at a wonderful price is a cigar butt, cheap but fundamentally flawed. A wonderful company at a fair price is a business with a durable, long-term competitive advantage. It's a business you'd want to own forever. Munger pushed Buffett to pay up for quality. He argued that over the long term, the return you get from an investment is going to be very close to the underlying return on capital of the business itself. So, if you buy a truly great business, even if you pay a price that isn't dirt cheap, the sheer power of its compounding earnings will generate fantastic returns over decades. This was the new philosophy, that would guide Berkshire Hathaway for the next 50 years. The first major acquisition that truly reflected this new Munger-influenced philosophy was See's Candies in 1972. By Graham's old metrics, See's was not cheap. Buffett and Munger paid $25 million for a company with only about $8 million in tangible assets. Graham would have never approved. But See's had something that didn't show up on the balance sheet: a powerful, beloved brand in California. People had an emotional connection to See's. They bought it for holidays and special occasions. This gave the company incredible pricing power. Every year, they could raise the price of their chocolates a little bit, and customers wouldn't even blink. They would just pay it. This meant See's could generate high returns on its capital with very little need for new investment. It was a money-making machine. The See's acquisition taught Buffett and Munger the immense value of an intangible asset like a brand, what Buffett would later call an economic moat. The concept of an economic moat is central to the modern Berkshire philosophy. Think of a business as a castle. The profits it generates are the treasures inside that castle. Competitors are like invading armies, always trying to get in and take those treasures. A strong, sustainable competitive advantage is the moat around the castle. It's what protects the business from competition. A moat could be a powerful brand like Coca-Cola, a low-cost production advantage like Geico Insurance, or a network effect like American Express. Buffett and Munger made it their life's work to find castles with wide, unbreachable moats. Now, let's talk about the engine that powered all of this: insurance. Buffett's true masterstroke, the financial architecture that allowed him to scale his investments, was his use of insurance companies. In 1967, he bought National Indemnity Company, an Omaha-based insurer. On the surface, it was just another business. But Buffett saw something that few others did: the power of float. Here's how it works, and it's simpler than it sounds. Insurance companies collect premiums from their customers today, but they might not have to pay out claims for months, years, or even decades later. This pool of money, the premiums they've collected but haven't yet paid out, is called the float. It doesn't technically belong to the insurance company. It belongs to the policyholders. But in the meantime, the insurer gets to invest it for its own profit. Buffett realized that float was essentially a massive long-term loan with no interest rate. In fact, if the insurance operations were run well and collected more in premiums than they paid out in claims and expenses, achieving what's called an underwriting profit, it was better than an interest-free loan. It was a loan that someone was paying him to take. This was the Holy Grail. Berkshire's insurance operations provided Buffett with a continuously regenerating river of cash that he could then deploy to buy more wonderful businesses like See's Candies, the Washington Post, and Coca-Cola. His investment in the Washington Post in 1973 is another classic example. At the time, the market was in a downturn and newspaper stocks were out of favor. But Buffett saw that the Post had a virtual monopoly in its market. It was the dominant source of news and advertising in the nation's capital. It had a deep moat. He bought a huge stake for about $11 million. By the 1990s, that stake was worth over $1 billion. Then there's Coca-Cola. He started buying it in 1988 after the market crash of '87. Again, he saw a business with an unassailable moat. Coke wasn't just a drink, it was an idea, a piece of culture present in nearly every country on Earth. He saw a business that could grow for decades, and he bought over $1 billion worth of the stock, which became one of Berkshire's most successful investments ever. But Lowenstein's book isn't just a series of investment stories. It's a portrait of the man himself. And understanding his character is just as important as understanding his financial techniques. Buffett is famously frugal. He has lived in the same house in Omaha that he bought in 1958 for $31,500. He's known for driving modest cars and eating at McDonald's. This isn't an act. For him, a dollar spent on a lavish luxury is a dollar that can no longer compound. He sees it as squandering future wealth. He once calculated that a $300,000 haircut compounded over time would cost him billions. He is also a man of incredible focus and discipline. He famously said that the difference between successful people and really successful people is that really successful people say no to almost everything. He spends most of his day, even now, just sitting and reading. He reads annual reports, trade journals, and books. He's not watching stock tickers or listening to pundits on television. He isolates himself from the noise of Wall Street by living in Omaha, allowing him to think rationally and independently. This brings us to his core philosophy on how to operate in life and business. He preaches the importance of staying within your circle of competence. This means you don't have to be an expert on every company or industry. You just have to know the boundaries of what you do know and stick to that. He famously avoided the dot-com bubble of the late 90s, not because he knew the tech companies would crash, but because he admitted he didn't understand their businesses or how to value them. He was mocked for being an old-fashioned dinosaur, but he was the one left standing when the bubble burst. He also places an immense value on reputation. One of his most famous quotes is, "It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently." This wasn't just talk. In 1991, Berkshire's investment bank, Salomon Brothers, was caught in a massive scandal involving illegal bids for U.S. Treasury bonds. The firm was on the brink of collapse, which would have threatened the entire financial system. Buffett, as a major shareholder and board member, stepped in. He flew to New York, took over as interim chairman, and worked tirelessly to clean up the mess. He testified before Congress, fired the wrongdoers, and implemented new ethical standards. He did it not just to save his investment, but to save the reputation of the firm and, by extension, his own. It was a grueling ordeal that showed his principles in action under extreme pressure. Roger Lowenstein's biography paints a picture of a man who is a bundle of contradictions. He is a ruthless capitalist who has accumulated one of the world's largest fortunes. Yet he lives a simple life and plans to give almost all of it away. He is a mathematical genius who can calculate complex probabilities in his head, but his biggest decisions are based on simple, common-sense ideas about business. He is a folk hero from Middle America who is also one of the most sophisticated financial minds on the planet. So, what are the ultimate lessons from The Making of an American Capitalist? The first is the incredible power of compounding. Buffett calls it the eighth wonder of the world. Starting early, being patient, and letting your money work for you over decades can create wealth that seems unimaginable. His entire fortune is a testament to this principle. It's not about timing the market or getting rich quick. It's about slow, steady, and relentless accumulation. The second is the crucial importance of temperament. Buffett has said that the most important quality for an investor is temperament, not intellect. You need to be able to think independently and control your emotions. You must avoid the herd mentality, buying when others are panicked and being cautious when they are euphoric. This emotional discipline is what separates the great investors from everyone else. Third is the idea of treating a stock purchase not as a blinking quote on a screen, but as buying a piece of a real business. Before you invest, you should be able to explain, in simple terms, how the business makes money and why it will be making more money in 10 or 20 years. If you can't do that, you're not investing. you're speculating. And finally, the commitment to lifelong learning. Buffett is almost 94 years old, and he still spends his days reading and learning. The world changes, businesses evolve, and the only way to keep up is to constantly absorb new information. He sees his mind as his greatest asset, and he invests in it every single day. The story of Warren Buffett, as told by Roger Lowenstein, is not just about how to get rich. It's a manual for rational thinking. It's a lesson in patience, discipline, and integrity. While none of us might become the next Warren Buffett, we can all benefit immensely by adopting his fundamental principles. Think for yourself, invest for the long term, insist on a margin of safety, and never stop learning. That is the enduring legacy of the man from Omaha.